By now, we've covered why it's important to create an investment plan to help you reach your financial goals. A plan helps keep your target milestones realistic, and it helps you stay on track. But before you can chart a course, it's important to first determine where you are with your finances. To assess your financial picture, you should start by looking at the assets you own, the debt you owe, the income you earn, and the expenses you pay. You can organize this information a couple ways, by creating a personal net worth statement and a personal cash flow statement. These are helpful documents to outline your financial state at any point in time. Let's go over each of them. A personal net worth statement is similar to a balance sheet that a registered company uses for their accounting. This statement provides you with a better understanding of where your finances stand today. In this statement, you should include all the things you own, which are called assets, and all the things you owe, which are called liabilities. Examples of assets would include cash, savings, and any property that you own. Examples of liabilities would be any outstanding loans such as mortgage or credit card debt. Let's see what a personal net worth statement can look like. In this example, the assets are listed out in the column on the left, and they are divided into 3 categories. First, cash and cash equivalents. This is liquid cash, or cash that you can easily access. You may have it sitting in a checking or saving account. Second, investments. This is money that you can have in a trading or retirement accounts, for example. Third, long-term assets. This can include things like property and vehicles. Try to indicate the current fair market value of these types of assets. For example, if you've owned a car for several years, write its estimated current value, since it has likely depreciated over time. The numbers you enter do not have to be 100% accurate, but they should give you a good estimate of the value of your assets. Once you fill out this information, total it at the bottom. Now, let's go over liabilities, which are organized on the right. In this example, loans and line of credit are bundled together in one category, and mortgage and car loan are bundled together in another called long-term debt. Again, the numbers you enter do not have to be exact, but it's important to be honest when entering this data. When you're done, total your liabilities just as you did with your assets. Now it's time to determine your net worth. To do this, subtract your total liabilities from your total assets. TD provides a convenient way for you to create this statement with the TD Personal Net Worth Calculator. This is a free and easy-to-use tool that not only helps you organize your information, but also breaks down the results for you as well. In these sample results, you can see short summaries that explain what your total net worth means. Below the summaries are suggestions for ways you can improve or raise your net worth, with links to other tools and tips that may help. Once you've created your statement, it's always a good idea to save a copy and revisit it at least on an annual basis to ensure it's up to date. Next, let's move on to how you can determine your cash flow. Creating a personal cash flow statement can help you understand your ability to save and whether you are living within or beyond your means. It's essentially a calculation of your budget to help determine your standard of living and how much money you have to save and invest. Let's look at a sample cash flow statement. In this example, you can see income and expenses are listed on the left. You can record the totals as monthly or annual values. It's up to you. But for the purpose of this explanation, we'll use monthly numbers. These are just some examples of income and expenses that you may have. You may also have other sources of income, like rent from a property you own, for example. You might also have other regular expenses too, like groceries, a gym membership, internet, car, even hair appointments. One way that you can figure out these items is by exporting your credit card, banking, and other financial statements into an Excel spreadsheet, categorizing your expenses, and then entering these numbers into your cash flow statement. Once you're done listing the values in each column, total them up and calculate the difference so you can see your net cash flow. A positive net cash flow means you're earning more than what you're paying in expenses. If you have a positive net cash flow, then you might already be keeping this extra amount in your savings. It's good to know that those funds could be invested for future needs as well. If your net cash flow is negative, then this means that you're spending more than what you're earning. This amount is likely going to add to your debt over time, so it's important to carefully examine which expenses you can cut to reduce spending and generate a positive cash flow. For those who prefer an online tool, there is the TD Personal Cash Flow Calculator. It's a free resource that allows you to record your income and expenses easily. Like the TD Personal Net Worth Calculator, you will receive a couple short summaries that outline your current state, as well as things to consider going forward. Aim to review your cash flow at least on an annual basis or when your finances change, like if you're having a new baby or are starting a new job. Now let's talk about debt for a moment. If you go through these exercises and see that you have a lot of debt, consider using the TD Debt Management tool. By entering your information, you can see your total monthly and annual debt payments. This tool can help you understand your capacity to handle debt and also offer strategies and tips to help reduce your debt. When it comes to the money that we owe, there are a few key things to keep in mind. First, there are costs to borrow money and to carry debt. This cost is commonly known as interest. This means that unless your lender is a generous family member or friend, you will typically be charged interest. Interest rates can vary, but you should know that they can spike to 20% and beyond per year if you're taking cash advances from some credit cards. Coupled with the compounding effect, this can cause your debt to grow significantly. Interest and compounding are powerful financial mechanisms that should be working in your favor, not against you. A best practice for everyone is to save money and pay down high-interest debt regularly. If ignored, your debt can increase, which could leave you paying off the interest for many years to come. This may prolong your ability to invest towards your financial goals. However, if you work steadily to pay off your debt, you could give yourself the opportunity to invest, which may enable you to build your wealth for the future. Let's look at an example. Jennifer has a monthly net cash flow of $200. She owns a house with a mortgage of $300,000 with monthly payments of $1,800. She was able to get this mortgage at a fixed rate of 2.5%. She's also been carrying credit card debt of $8,000 at a rate of 18%. She has only been paying off a small amount of the balance every month, $50. Every month, she is charged approximately $120 in interest on her credit card. It's safe to say that Jennifer is digging herself into a financial hole. She is adding more debt to her credit card every month as her interest charges are greater than the payments she's making. So what are some ways that Jennifer can solve her problem? She has a few options. Jennifer can look at securing a loan at a far lower rate than her credit card to reduce her monthly interest. She can also look at increasing her income or liquidating assets to pay off her high-interest loans. By assessing her financial information, Jennifer realizes a plan to pay down her debt. Now that you know how to determine your financial picture, you can set realistic goals for the future. We'll get into goal planning a little later on, but here are some considerations to keep in mind for now. When you're setting financial goals, try to make them specific and based on a realistic timeline. Build some flexibility into your plan to prepare for emergencies. Analyze or research your goals. For example, if your goal is to save for education, look into the current costs and trends in costs. Are they rising, and by how much? You might also want to consider inflation. Inflation is the rate that goods and services increase over time, and it might affect your goal, especially when it comes to targets that are long-term. Ask yourself how much you need to save now in order to pay for goods in the future, given that prices are expected to rise due to inflation. For example, if you want to plan a vacation for 5 years from now, and you know that the vacation costs $10,000 today, how much might it cost in 5 years if inflation rises 2% every year? Once you know your personal financial picture, you can see how much money you have available to start investing. Remember to update these documents with any changes to keep them as current as possible. The next thing to consider is which investment accounts are right for you, and this is something you'll learn about in the next lesson.